Okay, thank you for coming. So this topic is about how I select options to trade. So and see if you can relate or see if you can learn something. Maybe some aha moment comes to you. So that's the purpose. So when we are learning something, aha moment should come, and then you write it down, your aha moments, and then you dig deeper into it, whether you like the idea that somebody was telling you, and then don't shut it off right away. You know, just delay your decision whether you like it or not. So delay your decision. Just write it down that this is what he was talking about, and does it make sense? Maybe you consult with your trading buddy or someone and do something. So just write it in your worksheet. Maybe it doesn't make sense to you right now. Maybe it makes sense to you 1 week, 2 weeks, maybe when you are driving or maybe walking or you're going to sleep or shower, then something comes up. Maybe you're trading and then you say, yeah, I noticed that and maybe that was making sense. So let me go and do my own research. So things make sense. So later on, not right away, but later on, because then you recall that that person said something, and that was true. I think so. I need to go dig deeper. So don't shut. When we are learning, we tend to shut down other people's idea, and then we just block ourselves. So in this short topic, there's 3, 4 slides. I'll tell you how I select options to trade. So people make mistakes in trading options. So I learned from my own mistake that what I should be doing when selecting options. So we may be right in our um, stock analysis, market analysis, but then we are wrong in trading options. So that's where we get clobbered. So I give you some examples and explain. So we all know options have a strike. We know options have expiry date. We know options are in the money, out of the money, at the money. It has a theoretical value of ask. So based on the Black-Scholes model, and sometimes the options are trading above that price or below that price. Options have spread. Options have open interest. Options have volume. Options have implied volatility. And then there are standard options and non-standard options. So when we are selecting the options, we need to go through all this and make sure that we are selecting the right options. Is webinar on? Yes, it's on, Carlos. I don't know. Isn't it on? So it's on. I cannot hear the webinar. I don't know, Carlos. Something wrong. Can you hear? Can you guys hear me? Hello? Can you hear me? Yes. Okay. So Carlos, something wrong with your system. So so I give you example. So current price of a stock versus the strike price. So let's say the stock is trading at. I'm looking for the calls, and the stock is trading at, let's say 72. So if the stock is trading at 72 and I'm looking for the calls, then so I have an option. Maybe the options are listed like this: strike 70 and strike 75. So if strike 70 is listed and strike 75 is listed, and the stock is trading at 72, then I need to decide whether I select the 70 or I become cheapo, and I say, okay, I'm cheap, and I will select 75 strike. So, so what happened? The stock was at 72 strike. I selected 75 because I don't want to pay too much premium. I said no, I just 70 is expensive. I'll select 75. So we bought 3 points away from the stock price. Now, if the stock hits the target 70, let's say the stock goes fast towards 75, then our out of money option will make, in terms of percentage gain, it will make decent gains because the stock just ran towards 75 strike, and that was our the strike, and the target was 75. So when the target 75 hit, our calls became at the money, and a lot of premium got built in, and then we sold it. So we make a good amount of money when we do like that. If we expect the stock to go fast towards our out of the money strike, which is 75. Now, if let's say if the stock doesn't go towards the target of 75, then the option will lose time value. And even though the stock will hit 75, but your options are not making money. So logically, because the strike was far 3 points, so logically we should be buying in the money, which is 70 strike. Now, if we had 72.50 strike, which was just 50 cents away, maybe I would buy 72.50 strike because that was only 50 cents away. But if it's 3 points away, then I would prefer to buy 70 strike. And also, I have to understand how fast the stock is moving. So, is there a momentum there? If there's a momentum there, and even if the momentum is there, the momentum dies, and then I run out of luck. So if we are pretty sure there's a big news and momentum, then I can buy out of the money calls. So in the money, out of the money, out of the money call, I also buy when there is an event coming up. So if there's an event coming up and I know the option will move uh, big, either both sides. So if it's option moving big both sides, then I'm just taking like I'm just gambling. I'm just taking a flyer. So uh, if I estimate the stock is trading at 72 and if the earning comes up or there's a momentum, maybe I'll buy 75 strike or 77.50 or maybe 80. That's too far. So if I expect the stock to jump at 80 and above, so that's like gambling. So we can do the gambling like that if you want, but expect you can lose 100%. Add the money when you're buying stock options. Add the money, you're paying for the premium. So buying at the money option is not advisable. So buy one strike or two strike in the money, or if you think there's an event coming up and you need to just take a little risk, then buy out of the money calls or puts. Another thing, the theoretical value asked, so what's the should be the price of the option and what it is there. So compare the theoretical value with the current price of the option and see if it is close to each other. If it's far, then the options are overpriced. So we don't want to buy those options which are overpriced. And you can check through the implied volatility. Sometimes the implied volatility is high, but it doesn't mean that the higher implied volatility options cannot be bought because they become more and more expensive. So there is some event coming up. That's why the implied volatility is there. And that may be telling you something. So sometimes when you look at the stock chart, and technically it's telling you that you need to trade. And then when you look at the implied volatility, it is also telling you something about through the option data. So maybe uh, uh, it's like a double confirmation. The implied volatility is high, the stock is moving, and technically it's looking good. So you may want to you know you may still standard option. So when the stock have a dividend or the stock gets split, then they create various funny is it a 3-to-1 split or 5-to-1. So trading those non-split, I'm sorry about the voice is breaking. Okay, some saying is working good, some are saying no. Anyway, I'm sorry. So non-standard options. So try to avoid non-standard options, which you see like is 4.44. So when you see that non-standard options, is because the stock has either a split or there was a dividend split. Something when some event occurred, and that non-standard options may have a big spread, or there may not be a volume there, may not be an open interest there. So if there's no open interest and the volume is low and the spread is high, so try to avoid those non-standard options because they are just temporarily there. When the expiry comes, then they will go away. So those options will go away. But if that's the only strikes available, then you would see the option volumes there, the open interest is there, the spread is normal. So if you see something funny in option, then see why why you're seeing it and whether you have other options to select. So avoid non-standard options, but if that's the only options available, then and you think everything is all right in terms of volume, options, spread, open interest, then um, that's you need to select. So uh, so now the strike. So the point of the strike. So strike needs to be also selected based on what else you're seeing. So for example, the strike can be selected based on the targets you're seeing or the support levels you're seeing or the resistance levels you're seeing. So I give you an example. So let's say the stock is trading at 95 and there is a target of 97 and then there's a target of 100. So and then there is a support of let's say 92, 50 or 93. So these data you have 92.50 support, the stock is trading in 95 and the target is 97.50 and then there is a target of 100. So how do you, which one you select? So if you select 100, that's out of the money. So you better be right and better be right quick. So not only you need to be right, but you need to be right quick. So the dagger, the sword is hanging on you. You need to be right every time, every day you're paying the rent. So then another, so what you do, so if the stock is trading at, let's say 95, you may want to select a strike of 92.50 or even 90, if that's the support level. So if the support level is 90, 92.50, that's where ideally, in my opinion, you should select the strike. Because if, think about this, if the stock goes down to the strike level, to the support level, then you're still in the money and when the stock rebound, then your option will recover faster than those strike which you are buying out of the money, let's say 100. So if the stock was trading at 95 and you bought the strike at 100 and the stock goes to 92, then from 92 and then it has to come back to 95, your entry price, and maybe that entry price became the resistance, so it hit the resistance and then it comes back to 92. So it wastes time and your strike is 100. So it will take time, and by the time you hit the 100, your option is still losing money because you were right eventually, the target hit, but you lost an option. So logically, the options, so find out when you're trading long side or when you're trading doesn't matter if you're trading long or short, you have to know the support and resistance level. Where is the support, where is the resistance level, and what kind of support and resistance is. So when you are selecting the stock to trade, identify these levels. So support must be strong if you're going long, and resistance should be weak. So if the resistance is weak, then and the support is strong, so you may want to buy the strike based on the support level, that the strong support. So if the stock is trading at 95 and the support level is strong at 92 or 90 range, you know that this is a strong support. So you select that option of 90 or 92.50 strike. So if you select 100 or even at 95, you may lose the money. Now, um, on the upside, if you are going out of the money, if you're buying out of the money strike, then make sure that the out of the money strike is below the resistance level, major resistance level. So for instance, if let's say if the resistance is 90, if the stock is trading at 92 and you buy 95 strike, which is out of the money, the resistance must be above 95. Let's say 96, 97. So then you will be fine, because the stock is trading from 92 to 95, and by the time 95 target hits, your options are at the money. The resistance is at 96, so you will be out by then. But if the resistance is 94 and you choose to strike 95, then it is beyond your resistance level. So that's not, I think that's not a good idea. So evaluate the option support, evaluate the resistance, and then decide. Uh, Check the momentum, check the time period you have, check the event, and then you decide where is the resistance, where is the support, what should be my optimum option. Also pay attention to the volume of the option. So volume can tell you where the activity is. So because you're not the only one who's trading in the market. There are millions of traders trading, and the law of crowd. The crowd is usually right. So follow the crowd. So, so if the crowd, so you do the analysis and you know that 95 is the target and 96 is the resistance, and the stock is trading at 92, and there's a lot of volume at 95, and you feel, if you feel that yes, 95 will hit, and the crowd is also um, buying that 95 strike. So if you want to follow the crowd, you can buy the 95, but you have to you do your own analysis and then see if the other people agree with you. And if your analysis is coming up something else and others are agreeing something, then you need to be extraordinary, like extraordinary trader, that you're going against the crowd. So maybe you just your direction is right. You just don't want to take the risk and don't want to follow the crowd. You go in the money. So when they are right, you are right. The stock hit the target and they made good gains in terms of percentage. You also made the gains, but your percentage gain will be less because you're buying in the money. So do all this evaluation when selecting the strike, the short strike, and the calls and puts. Similarly for the puts. So for the puts, so when you're buying the puts, you have to evaluate where is the strong support, where it can go and sit there. So once you identify the support, that could be your strike. If the usually what the stock, they go down fast rather than going up. So since the stock is falling because of the fear and panic and everything, one bad news and everybody wants to get out. People go in the building through different entrance. But they jump from the same window. So jumping from the same window, entering from all the doors. There are hundreds of doors. They are entering in the building from all the doors. But when the fire breaks out, they jump from the same window. So when the stock is falling, it's just falling. So for the stock, if you see something moving down faster, maybe you can buy out of the money puts, but the puts should be, if that is your strategy, you buy out of the puts, money puts, but then puts strike should be taken into consideration at the support level. So where the support is. So identify where the support is and just buy and see if the support is, there is a strike just above the support. So if the support is, if the stock is trading at 100, let's say the stock is trading at 100 and is falling down, and you see the support at 94, maybe you can buy 95. If you buy, you can buy 95 strike. So if you buy 95 strike, when the support is hit, you are, you're there, right there in the money. But if you buy puts at 90 and the support is 94, then it just got, it will rest itself at 94, and then you may not be as profitable. So when looking for the option for the puts, make sure pay attention uh, to the support. Another thing you can do, let's say you're buying puts, if you want to buy in the money, then look at the resistance level. So for the puts, you need to pay attention to the resistance level also to make sure that the stock doesn't go above the resistance, like doesn't go against you faster. If it wants to go against you faster, then it needs to conquer the strong resistance level. So if maybe you buy in the money puts right at the resistance level. So let me give you some example. Later I'll prepare some charts to explain. I'm just talking in theoretical, and I hope you understand. So let's say the stock is trading at 95 or 96, and the resistance, heavy resistance is at 100. So and you see it falling towards 90. So one option is you can buy 90, which is out of the money. You can buy 95, which is at the money, so you're paying for the premium. Another one, strike, I prefer is to buy 100, because 100 is a strong resistance. So I buy in the money, and 100 is strike. So doesn't, if the stock goes above and start moving up, retracing upward, I will not lose that much time premium, because I see the 100 is the resistance and it will stay below 100, and eventually the stock will fall. And when the stock falls, then I will recover the time premium lost. But if I buy 90 strike and the stock is trading at 95, then eventually it will come down and hit 90, but I will not be in profit. So I will eventually end up losing money in that trade. So depending on you're doing calls or depending on you're doing puts, evaluate the support levels, evaluate the resistance level, and all the other data. For instance, the spread. So spread has to be, so pay attention to the spread and see where the spread is normal and where the spread is huge. So pay attention to that, where the activity is during the day, where is the open interest, where is the volatility normal, whether you're selecting standard options or non-standard option. Pay attention to the expiry dates. People forget, sometime in the month of November, there is expiry in every week. There is expiry. So there are weekly options, there are monthly options. So I trade monthly. So pay attention that you're choosing the right expiry, which is the third Friday, because there is a normal volumes and everything going on in the third Friday expiry. So if you buy quarterly options or weekly option, you may end up losing money. So pay attention to all this: the standard option, non-standard option, the expiry, the volatility, where the volume is, where is the activity, where is the spread normal, where is the open interest, which option is close to the theoretical value, whether I should buy at the money, in the money, out of the money, is there any event coming up, where is the target, where is the support, where is the resistance, how fast I expect the market to move. Another thing you need to pay attention is the general market conditions. So if the market is bearish, market is going down, so out of the money puts will work, because the market is going down and everything is going down. So out of the money will make you more money. But in a normal, or then maybe you choose in the money puts. So see what kind of a market it is and what kind of event is coming. So if there is any FOMC event coming up, maybe the stock will just move down faster, and you're already positioned via out of the money puts, and your puts will give you great gains in triple digits. Maybe there is a product announcement coming up, so you know the product announcement coming up, and you position yourself via out of the money. So it's just an event you are trading. So when you're trading event, um, you have to decide what will be the effect of the event and where the market can gap up. So gapping up, gap down, if you can estimate where the market can gap up or gap down, that's maybe the strike you choose. So do the analysis on that. If there is any government announcement coming up, what effect it will have. So what kind of option you would be trading. Earnings event. So earning event, when the earning coming up, you know it's a coin toss where the stock can gap up or gap down. So if you can estimate the effect of the earning, that what kind of earning event will be and where the stock can move. So let's say you select, the stock is trading at 76, and you think, okay, the earning will come and 75, 74, 73 is the support. and when the earning comes, the stock will jump to 80 and beyond. So if that is you can if you think that's the case, then you may buy 80 strike option because you expect the stock will gap up 80 strike, and then you will be in the money and you will be out. But what if the stock doesn't gap up? It gaps down. So when it gaps down, where is the possibility of the stock to gap down? So if it's trading at 75 and earning is expected and you expect 80, but you have to see where else it can where it can move. So maybe it will go to 72, 73, 70. So then your 75 strike will just completely wiped out. So maybe you want to buy, if you want to play the earning, maybe you want to buy 70 strike, knowing that if the stock gaps down, it will gap down to 70 and I'll be in the money, still in the money, and I will have time to manage the trade. I can manage the trade by buying more into it. But if I'm buying 80 strike, I'm taking a flyer. So there's no management there. If I buy 80 strike when the stock is 75 and it goes to 70, then there's no management. It just it goes to zero. So think about these kind of situations. So what event is occurring, and maybe you don't, when you're buying out of the money call for event, you don't need to buy too much time. You're just buying 2 weeks, 3 weeks out, because if you're right, you're right. So you're not paying for the too much for the time premium. So the options are cheaper if you buy 2 weeks, 3 weeks. But then again, it's a speculation. It's not trading. It's a speculation. And in the speculation, people make a lot of money and people lose a lot of money. So if you want to go systematic way, then you would avoid the earning. You would avoid buying 2, 3 weeks. You would avoid buying out of the money calls or puts. You would trade according to your rules and say, okay, what if I'm wrong? So what if this happened? Then what I will do, how I will manage the trade. So all that needs to be taken into consideration. Now, regarding the spread trading, so I give you one example of the spread, and I'll go into details some other time. So the spread trading. So if you're buying, so the spread trading is where you buy one long calls and then you sell, so let's say you're buying vertical. So you're buying one long calls and then you're selling the short. So ideally the short calls should be sold, which is your target. So if the stock is trading at 100 and your target is 110, maybe you buy long calls at 100 and then your short will be 110. So when the stock hits 110, you maximize your gain. So when the stock hits 110, the short call will move up, but the 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 long call will move even more. So the net gain will be, you will maximize the gain. So the short strike needs to be selected at the target level, where you think is the target or where you think is the resistance level. So that is the spread trading. Or maybe if the 110 is the target and the stock is trading at 100, maybe you buy long calls and in the money like 97.50 or 95. So you're being less aggressive. So when you're buying the long call in the money, you're less aggressive. And if you buy out of the money call, the long ones for the spread, then you becoming aggressive, very aggressive if you buy out of the money call for your spread. And when you buy at the money, if the stock is trading at 100 and you go long with the 100, then you are medium aggressive. So again, you need to decide what kind of trader are you. Are you aggressive or medium or very aggressive? If you're very aggressive, then you will buy 105 strike long and sell 110. So both of them are out of the money. And when the options doesn't move, then both will expire worthless, and then you will lose completely. So think about all that. What kind of trader are you when you're putting the spread trade, whether you're aggressive, very aggressive, or just normal? So if you're conservative, then you will be buying in the money calls and selling out of the money call. So think all that when you are selecting the options to trade. Now, the market conditions have to be taken into consideration. Sometimes the market condition is very bullish, So when the market condition is very bullish, then out of the money calls will make you a lot of money because everything is just hitting the target. And it's no magic of your own. You're not a genius. I'm not a genius. Okay, I become a genius. Everything I touch become gold. So it's not. It's the market. So at that time, when the market is bullish and you recognize the market is really bullish, then you can trade out of the money calls and make a lot of money in terms of percentage gains. Same way in the bearish market, if you buy out of the money put, it will make you a lot of money, especially when the volatility is high. One day it just goes up and the next day it goes down. So if you are right, you catch it, you in terms of percentage, you make a lot of money. Sideways, if the market is sideways, you will lose your option if you are buying out of the money calls or puts. So for sideways market, you need to be in the money to preserve. Your target will hit, but it's taking time. So technically, you're right, but time-wise, you were not right. So you estimated the time wrong, and you were right eventually, but you will. So we say like this: damn, I told you I'm right, but now, I'm still losing money. I was right, but I'm losing money. So, well, you were right, but you're losing money because you did not select the options correctly. So if there is a momentum in the market, whether up or down, then you can change your strategy for option selection. Now, another thing which people make mistakes in selecting, in my opinion. So I'm just giving you my belief. So remember, we trade our beliefs and we give our opinion based on our beliefs. So this is my belief and I'm giving you, so you can adopt based on your belief. So there are time when we need to average down. So sometimes we have the way the chart is, or the way the option is, or the market, we can trade the same strike and same month. We can buy more of the same strike and same month, which we have. So if we bought 80 strike, let's say I give you an example. Let's say we bought December 80 calls. Let me create an example. December 80 calls, we bought at $4. And so December is far, and now the stock is trading at let's say 77, 76. So now we are losing money on that. So, and then the stock, it starts to move up and it's close to 79, and our $4 option is trading at $3. So because of the time we have on hand and the strike is the stock is not very far from the original strike, we can add the same strike and same month, because it's not much. Time decay is not kicking in. The stock is not far from the our original entry, so it's okay. And it's just that option is trading at 3 because the time it the time was wasted. So the option which was trading at 4 now is trading at 3. So I can average down the same strike and same month. Now, when I'm averaging it down, the same strike and same month, I need to make sure that I buy more contract when I'm averaging down than the original number of contract. People make mistake. They buy same number of contract, same number of shares every time they do the average. That's not the right formula. The formula should be the equal dollar. So if you bought, let's say if you bought at $4, and let's say you bought 5 options, so you spend $2,000. Now the options are trading at let's say $3. So for the same $2,000, you can buy 6.5 contracts. So, but there is no half. Maybe you can round it to 7, or maybe you can round it down to 6. So this time you're buying 6 contracts because it's the same dollar you're investing, or 7. So now if you buy 7 and before you bought 5, so 7 plus 5 is 12. So your average will be below 4, somewhere like 320, 330. So always try to understand when you are averaging down, why you are averaging down. Like I receive email saying, the option is down 50 cents. Should I average down? It looks good right now. Should I average? So what's the point of averaging it down? Don't average down based just because you want to average down. You average down because the stock is telling you that your original thesis is correct, and I am going up. So I give you one example, MU. So we bought MU calls and it went down, and now today was going up. and it's to me it looks like now the direction is reset to the upside. So the correct time to average down on MU is today. So if you're already in the MU trade, so just don't average down because of the average down sake. Now, if I have December calls and I have time, and the strike is not that far from the stock is not trading the same from the current strike, then I would buy, and I will average down MU with the same strike and same month, December. But if let's say I had November calls or October and it's expiring, I would not average down the same strike and same month, especially same month, because it's throwing good money on the bad money. So don't do that. Sometimes so these are the combination. You can average down same strike, same month. So you need to do the evaluation. You can average down with a different strike and same month. So you have enough time on hand. Let's say you bought the calls December 80, and so December you still have time. And MU is trading at, let's say, 76. So, and originally you bought 80 and MU is trading at 76 and you want to average down. So if you average down 80, maybe it will move faster and then you will recover your loss and you will turn into gain. And the time by December is correct. Maybe ideally you should add some December 75 and then manage the trade December 75 and December 80 as a basket. So maybe at some December 80, when the stock hits 80, you don't make that much money, but your December 75 is making you money. So if the stock is trading far from the strike, don't average down the same strike. Is the delta you're adding the stock option where the delta is so low, your average down technique will not work unless you buy like thousands of contracts. Originally you had 10, and now you say, okay, I'm gonna buy 10, 1,000 options. Take flyers, and my average is like 10 cents now. So if that's your strategy, you can lose all that capital which you put, the old one and the new one. So don't do that. So you can change the strike, even though you're keeping the month same, because December have time. Now, if the time is also running out and the strike is also far original, so let's say you bought October 80 calls, and October is right here, and the stock was at 80 when you bought, now it's trading at 75. So don't buy October 80 calls. It's average down. Doesn't matter how good it looks, because you may end up losing more money. So think about it that consider it as a new trade. So think about it as a new trade. If would I enter in the trade if I did not have previous trade open? If the answer comes yes, then enter in the trade. And with a different strike and different month, and just manage it. So maybe the older trade you just break even or sell at loss, and the new trade will make you money. So you have to think whether it's good idea to buy the same month and same strike, or different strike same month, or altogether the strike is different and the month is different. All right, so let me uh, so this is recorded, so we will send you the recording. And uh, yeah, so I'm a visual based chart pattern trader. So you can say I'm a visual based chart pattern trader. So I'm looking at the chart on my daily time frame, and then I'm going through my rules. And if the rules go through pass, then I take the trade. Then I go and select the option. Sometimes I just skip the option trade because there is no option. There's no good option, so just skip it. Some options are crazy. The spread is wide. Some are crazy. Some have um, it's kind of expensive or higher price. So I don't want to trade higher price option, and I don't trade where the spread is wide or there is no volume there, and I'm the only one going there. So I may be right, but then when I go to sell, I am at the market maker mercy. There's no liquidity, so I'm the only one left there to sell, and then it's not working for me. So I'm right in my direction. Option is moving, but it's not moving the way I'm supposed to make a gain. So all right. So that's the end of today's session. So I can review, go back. So we talked about that when we're doing this stock and a technical analysis, we need to, and when we are trading options, so a lot of traders, they start trading options directly. I don't know if that person, I talked to one person, I will not name him, but uh, if he's attending my class, I will talk about him, even if he's here or not, just don't take his name. So I talked to one member, and this is what people do. When they trading, they come to an option world. They hear from the other people how lucrative it is and all that, Facebook and whatnot. And the first stock it jumps to them is Google, Amazon, Apple, Tesla. So Tesla is the main one. Oh, Tesla. I want to trade Tesla. Maybe they're driving Tesla, but they see Tesla, they listen, uh, Elon Musk, Twitter, and this and that. So they want to trade Tesla. So this person, he started. I asked him, okay, how many hours experience you have? So he just gave me, yeah, not enough. He just started trading, and he traded Tesla, and he made $400,000 trading options Tesla. And then he lost that 400,000, and then he lost 150,000 of his capital. So when you do the dissection of the, okay, so buying out of the money calls, and every time I'm right, or buying out the money put, so I'm right, so I'm making money, and then whatever money I'm making, I'm putting it more money, and I'm putting it more, whatever gains, just I cannot go wrong, I cannot do this, that, and then I'll lose that 400,000 profit. So now back to 150,000 capital. So I've seen the gain of 400,000. Now I need to recover that 400,000 back. So I started, trade at more, and then lose 150,000. So it's a, from peak to trough is like $550,000 loss. So uh, depression and everything, and then people try to recover. So what happened? People say like this. Okay, I know my mistake. My mistake was I was buying puts when the Tesla was going up. I should have bought calls. Or I was buying calls when Tesla was going down. So I should have bought puts. Yes, I know that's what you're supposed to do. Buy those stocks which go up and sell those stocks which go down. It's very easy to say, but not easy to do. So I try to try to tell him that, look, this is not the mistake you're doing. It is not that, okay, I figured out my mistake and I will just not repeat this. There will be another one, then another one, till you eliminate all your mistakes, like nail it down. Even then, you will have problems. So not all the mistakes can be eliminated. Even then, you will have a problem. So just don't think that you know now that the mistake I did, and I will not do that, and I will recover it. So it's not that easy. All right. So making 400, I mean, it was great. Making 400 in 6 months, starting from the beginning, and then losing it back, and then losing 150,000. So it's not good. All right. So it's not that easy trading. Okay. So thank you. I will send you the recording, and you can listen. Thank you.